Hello, everyone. I'm Ted Oakley, managing partner at Oxbow, and today we have Luke Gromen, who is one of the best at macro policies and telling people what they need to do in the micro section. And Luke, I take your service for the trees. I'd recommend other people to take it. I think you write about some really interesting subjects and give a lot of great advice. So we're glad to have you.
Well, thanks for having me on. I appreciate those kind words and appreciate your business. I look forward to our conversation.
Luke, you have a lot of great slides, but one of the ones you had was about back in '72 about a Time magazine cover. You might talk about that a little bit and sort of what that means now.
Absolutely. So there was a great Time magazine cover from 1972 brought up by Jack Farley and Mark Dow in a conversation they had recently, and kind of pointing out, rightfully so, that it was Uncle Sam turning his pockets out with the headline being "Is America broke?" or "Is the U.S. broke?" And their point in highlighting that was rightfully that the conversation around the U.S. fiscal situation and its unsustainability has been around for a very, very long time, and it hasn't been a problem yet. And all of that is true. And what we really dug into in that piece was highlighting sort of yes, and what exactly happened from 1972 to 1980. That's the reason the US didn't go broke then, and what that implied for different markets from 1972 to 80, and then how different the current fiscal situation is now versus 1972, both in terms of the level of debt and the level of deficits relative to GDP, just to try to give us a sense to handicap if we see those types of actions in the markets again, or reactions in the markets as we saw post 1972, could they be smaller, same, or bigger reactions given the level of debt and deficits? And what we found was that obviously the debt and deficits are orders of magnitude bigger now than they were then, which to me suggests that the reactions we saw in markets 72 to 80, which were pretty pronounced in their own right, when you look at what happened to rates, the dollar, gold, oil, industrials, etc., they you can make a case that they would be even more pronounced this time around in the next 5 to 6 years.
And in that regard, you have a slide that shows federal debt to public debt as a percent of GDP, and it goes all the way back to 1966, I think, or 67. And so what you're saying, I believe, I'm asking a question here, is it is different this time compared to what it was then with those numbers.
It is from the standpoint that it's more acute
All
and that
right.
it's a bigger problem. Obviously governments can never go broke unless they want to. I mean, it's a political choice. Ultimately, they can say we're not paying, but that's really the only way they can go broke in the private sector sense of the word. And so the reality is that when a government goes quote unquote broke, um, they end up inflating away the debt. You basically go through a period of high rates of inflation, which is generally how it works. Sometimes there's financial repression where the central bank or the authorities or both cap interest rates or mandate the private sector holding of debt at negative real rates, et cetera. And there's a long tradition of this in emerging markets over the last 40, 50 years. There has not been a long tradition of this in the Western markets, which is where the problems are now in the advanced markets. So it really is a case where it's more acute now than it was in 72. The problem is bigger now than it was in 72. And
Well,
so
you
here
have a
we are.
slide along that line that says where the ratio is greater than 30%, we're just about there,
Mhm.
which is a really great slide in terms of where we were in October 2023, and where we are now. And that's interesting. That's an insolvency ratio. You might just mention that.
Yeah, for sure. So that we calculated it, and it's what we call a gross insolvency ratio, which is just gross interest expense divided by federal tax receipts, going back to, I think we have it back to the late 70s. But at any rate, the point is that once that ratio hits around 30%, it starts to really get acute, and that's about where we were. Um, We were getting close. I want to say we were over 25% by last fall, and that we should be over 30 later this year. All else equal, there's some things that can change that. But ultimately, again, does that mean we're going to be insolvent? No. What it means is, for example, the last time the gross insolvency ratio of the United States was over 30% was in late 1984. And in February 1985, the dollar peaked and proceeded to be cut in half over the next 2 years. Somewhat different set of circumstances, but there are some things that rhyme with that time, not least of which is the currencies ultimately has to be the release valve. The currency and inflation has to be the release valve to get out of this when a nation gets into that position.
So right now, according to this graph here, we're about a third of the money we bring in is going to interest expense, roughly.
Yeah, on a pro forma basis, yeah.
Yeah.
Within a couple months, that'll be the case.
And then, speaking of that, you've talked about this before. I've watched you before talk about this as far as what happens with where interest rates should be, talking about interest rates and nominal GDP, like, and how that affects where we eventually end up with, with this dollar and the economy and debt and the whole thing. You have some good concepts on that.
Yeah, I think ultimately it's you need negative real interest rates in order to sustain the level of debt that we have, right? So you got to have interest rates below inflation, but that is a very unnatural concept in a free market. That doesn't happen in free markets because there's no, generally speaking, there's no suckers at the card table that will accept a bond yielding 4 when inflation's 5 or 6, and certainly not when it's 8 or 10, where they're losing money on a real basis. And when the amount of debt involved that needs that negative real rate to get earned out of is $35 trillion worth of debt, which is the balance of the U.S. debt in total. There's simply no one in the world with a balance sheet that big other than what they call the macroprudential authorities, right? The Fed, the Fed, it sort of begins and ends with central banks. They've got to create money and keep interest rates below the rate of inflation for a sustained period of time.
And you made this comment before. The first time I heard it from you, was that the higher for longer people talking about should have let the inflation rate run high.
Yeah, they should have. We did an analysis back in April 2021 based on the work of Reinhart, Rogoff, and others going back 10, 15 years that showed that it's very clear over the prior 120 or 140 years, anytime debt to GDP in a country gets above 100%, and certainly to 120% where we are, there's only 3 ways out of it. High inflation or hyperinflation, restructuring of the debt. In other words, they cut payments or entitlements, spending, etc., or some sort of productivity miracle. And so the productivity miracle we can set aside for the moment. That is looking more and more like a Hail Mary. So we're left with high inflation or some sort of restructuring of the debt. Now, as a practical matter, Treasuries are a special case because we're the global reserve currency. It's been the primary reserve asset for a long time, which everyone always cites as a favorable side. But in terms of our decision-making process of, okay, are we going to have high inflation and negative real rates, or are we going to restructure the debt? It's convenient that the dollar is a reserve currency and the Treasury is the primary reserve asset because we can completely rule that out, the restructuring side, because the Treasury bond serves as collateral for basically all financialized assets in some way, shape, or form. And so if you came in and said, all right, well, to fix our debt and fiscal problem, every Treasury out there now, is going to trade at 80 cents instead of par going forward. Thank you for your donation. You blow up the financial system because now everybody's under collateralized. And so we can just sort of set that aside and say, okay, that's not going to be the outcome. Like they can pretend, they can feint, they can try. It's a bluff. They cannot do that. Okay, then they're going to have to inflate it away. So that was our context going into this April 21 report, where we said last time U.S. debt to GDP was as high as it was in April 21 was in the immediate aftermath of World War II. It was 110% debt to GDP. Within 5 years, they got it from 110% down to 55 or 60%. At the lows, US real rates were negative 13%, if I recall correctly. So you had inflation running 13 points above the yield on the bonds. Bondholders got every dime they were owed. They just lost a lot on a real basis. Um, so I said, okay, let's use that same 5 years, 46 to 51, 50 percentage points debt to GDP decline, because I said, all right, I think we need 70, 80% debt to GDP to get back to, because that's roughly where we were the last time the Fed was able to sort of tighten in an independent manner without creating more problems than they were fixing. And then I also looked back to 2008 and said, okay, the US federal debt has grown roughly 8% CAGR, compound annual growth rate, since '08. So let's assume 120% debt to GDP today. The debt nominally grows 8% CAGR. We need to go 120 to 70 to 80% debt to GDP. And what is the implied real interest rate we would need to make that equation balance? And what we found was it was negative 12 to negative 18% real interest rates in the United States of America for 3 to 5 years. And initially, it looked like we were heading down that path, especially once we got that second and third stimmies that we sort of didn't need. To me, those made perfect sense in terms of, okay, they saw the BlackRock white paper from Stan Fisher, et cetera, in August of 2019, where the plan specifically said in the next crisis, we're going to cap rates and we're going to do a bunch of fiscal stimulus and we're going to inflate away the debt. I said, okay, they're running the game plan. They told you what they're going to do. They're going to do it. And they started to. And I think, and this is something I initially missed in the Fed rate hikes, I think politics got in the way. I think as we got into early 2022, inflation was starting to become a midterm electoral issue, and the Fed started to tighten. They did get some disinflationary impulses. They brought inflation down, but it was the wrong thing to do because it has now pushed the U.S. government into this fiscal dominance position where, we saw it last week. Bloomberg, we were talking about this with our clients a year ago, based on readings of Warren Mosler and some others in the MMT community, that yes, they get critiqued, but I think they've gotten this interest rates are stimulative when debt to GDP is this high dynamic exactly correct. Bloomberg had an article about it last week. Hey, there's this radical theory on Wall Street that interest rates are adding to inflation because they're adding to deficits. Well, yes, if we're going to raise rates and that deficit is going to go up a lot as a result, the Fed is paradoxically increasing the inflationary burden by raising rates. So I think they should have let rates stay low, let inflation run hot, 21, 22 into 23. We probably would have debt to GDP down. The risk, of course, that we'll never know because we can't argue the counterfactual is that, would there have been some sort of, UK fall 2022 bond market calamity? Possible. It probably would have forced the Fed into yield curve control earlier. Their balance sheet could be a multiple of what it is today. That all those are possible, but I really think they should have inflated higher for longer to take the pain early, because now it's going to get worse.
They also they've always got the stock market out here on the right ear, so the stock market would have had the same problem with those numbers. And I'm sure
I think that's right. I think that's right. And it's one of these things where it's an unfixable problem unless you do something extreme in at least one direction, right? So if you raise rates really high, you're going to create some big deficits,
right,
and they're going to be stimulative, and you're going to create a bond market problem that way. If you don't raise rates really high and you run very negative real interest rates, you're going to get high inflation, you have a bond market problem, you might have a stock market problem. If you don't, so there's the problem in any human enterprise. Once debt gets too high, the higher and higher your debt gets, the amount of available palatable options you have keeps shrinking, and it's no different at the sovereign level. It just is inflationary rather than deflationary.
I'd be curious about your thoughts. We've written a lot about the fact that probably the only time that you would really have the powers that be in Washington really face this down would be in a real calamity where they had to really be austere and do something, do the right thing, whatever that was. And do you see it that way, or do you think that I mean, it's basically just been kicking the can down the road here. We haven't really done much.
I agree with that. And again, with the debt, that's part of the reason why I think the wise thing to have done would have been to take the inflation up front and deal with that pain and political unpopularity is because the debt to GDP is so high now, you can't do austerity, right? So, perfect example, we're running a 7% of GDP fiscal deficit right now, roughly, was still pretty much full employment. So let's say we wanted to go back to just where we were in 1972 when we were afraid we were going broke with a 2% of GDP fiscal deficit. So we're going to take 5 points of GDP out effective immediately, permanently.
Hmm.
You can do that when you have 30% debt to GDP like Volcker did in the 80s, early 80s. You can do it even maybe with 70, 80% debt to GDP. You cannot do it with debt to GDP at 120%. The reason I say that is the great financial crisis, full year, we had about a 3% year over year decline in GDP. That was enough to nearly collapse the entire financial system, require massive, unprecedented bailouts, et cetera, et cetera. That was 3 points of GDP. We're talking about austerity just to get back to 1972 levels of fear of bankruptcy by taking 5 points out. So it's by taking 5 points out, you would paradoxically drive a calamity in the financial markets, a decline in GDP, and drive another great financial crisis where you would end up probably with higher deficit to GDP because your receipts would collapse, your counter-cyclical rebalancing payments would kick in, and you'd actually be worse off than if you hadn't tried to cut it all. And that's why I think they really made a mistake by not doing the courageous thing and just taking the inflation, a little bit of inflation up front.
Right.
Because they didn't, austerity, the market still for the moment believes austerity is an option. A day is coming in the not too distant future where it's going to understand the math I just ran through, when everybody's going to understand that math.
Yeah.
And that's going to be a really interesting day because then I think that's where we get the bond market, the long end just sort of takes off. And the Fed has to cap it then. So I think they're really trying to play for time, right? That you say, what's the happy case? You know, of our 4.5 trillion in receipts, 3.3 trillion of it are going to baby boomers every year. Social Security, Medicare, Medicaid.
Right.
So if I'm the Fed in my happy case, and of course they're all baby boomers, so it's probably not happy to them, but if a quorum of the baby boomer generation passed on very quickly in the next 2, 3 years, especially the sickest portion of it, such that that 3.3 trillion a year in payments out shrunk by half. That buys them time. That takes the criticality off of the situation they're in from a fiscal perspective. That might be what they're trying to say is hope they're doing that. But then, you get stuff like this weekend where we turn around and we're handing $1 billion to, Ukraine, Israel, and Taiwan. And like that to me just says they're not serious at all yet. They are in la la land. There's just no urgency whatsoever until we get the calamity.
Do you think will all of that means that in the future we'll re-up and inflation will come back at a much higher level?
Oh yeah, I think that's exactly what's going to
Yeah.
happen.
Having said that, I want to shift gears here because you have some really interesting things. And we'll take gold first because you've got some really interesting graphs on how when the FX reserves and dollar reserves when they quit buying the treasuries back in 14, I think in your graph here, then as soon as that happened, the gold versus treasuries started going higher. And you might talk about that a little bit.
Absolutely. So yeah, I think to me, it's one of the two or three sort of what I call big gears in macroeconomics over the last decade has been the fact that global central bank FX reserves stopped growing in 2014. And practically speaking, what that means is they stopped adding to their holdings of treasury bonds. Uh, Practically speaking, what that means is the world's biggest price insensitive creditor of the United States stopped growing their holdings of our debt. And then in the next decade, our debt proceeded to double from 17 trillion to 35 trillion. So what central banks did in the meantime is begin buying gold. And the easiest way to think about the implications of central banks not growing holdings of treasuries anymore while the supply started rising exponentially is, there was I used in the presentation, as you know, the Lucy oh, I can't think of her buddy, the chocolate skit, famous chocolate skit where the chocolates are coming down the conveyor belt faster and faster, and so they're trying to put them in the boxes and they can't, and so they can't keep up, and so then they're shoving them in their mouths and in their aprons and in their blouses and what have you. But there was a great article on Bloomberg maybe 5 or 8 years ago. For whatever reason, China's always one of the biggest importers of U.S. Scrap cardboard. And there was some period in time in the last 5 or 8 or 10 years, the Chinese said, stop. They just stopped taking our scrap cardboard. And so there was this lengthy Bloomberg article talking about, okay, so then the prices start to fall, and then the inventories start to build up, and then they start running out of room to stash this stuff. And so it's in warehouses all over ports, all over the country. Then it starts getting moved into the interior of the country where there's more warehouse space, and the prices just keep falling. And it's a little bit of the same dynamic, except that it's way more politically important, the price of the Treasury bond. It's the rate that discounts the entire global economy, the entire globalized system. And so what we can see since 2014 has been a process in fits and starts, where paradoxically you would think, oh, this is terrible for the dollar. No, it's actually great for the dollar in the short run. The fact that the world's central banks stop growing holdings of our treasuries, because what happens is the backup of treasury bonds begins to crowd out. They need to find new buyers, and that those buyers have finite balance sheet, and treasuries are at the top of the stack in terms of all the other instruments. And so as the supply of treasuries gets too big, it begins crowding out global dollar markets, which means there's not enough dollars, means the dollar actually paradoxically goes up, which then leads to this dynamic of, as the dollar goes up, foreigners have borrowed a lot in dollars. That starts to squeeze their balance sheets further, slow global growth further. They suddenly need more dollars to service their dollar debt. What do they have that they can sell to raise dollars? Treasury bonds. So now the supply of treasury bonds grows further and faster, rates up, dollar up. So we can kind of see how this has happened with interruptions of regulatory changes by U.S. authorities, where they regulated banks and then pensions and then money market funds, et cetera, into buying more of these treasuries with various inducements in terms of, hey, you can count these as bank capital, or hey, you can take a tax break as a pension. And ultimately, they still, given what deficits have done, ran out of balance sheet room. And in those periods of time, when we've had crises where the dollar is up big, global markets are down, especially emerging markets, and the Fed comes in and basically prints money, grows their balance sheet, buys treasuries, stabilizes the treasury market, wash, rinse, repeat. And these cycles have been happening faster and faster and faster. And, to finish, you can see the moment in time where global central banks stopped growing holdings of treasuries and bought gold, because gold and treasuries, gold have been outperforming the long-term treasury bond market in exponential fashion since 2014. It started a little by little, and in the last several years, it has massively outperformed long-term treasury bonds. And they are proxy instruments, so that they should be even at all times. And so if gold is winning by as much as gold is winning by, it's telling you there's a problem.
And you have, talking about that, you do have a graph or a chart that says they sell what they can.
That's right.
They only have one thing to sell, so they sell the treasury.
Yep.
And based on that, and now we're getting into that gold side, you talk a lot about how the dollar is going to face a backlash in the oil market now. If you look at the BRICS and what they want to do with gold, you might give your outlook on that. I think it's really good.
Thank you. Yeah. So that's, I think, another one of the big gears of macro over the last 10 or 12 years has been the increasing need of China in particular, Russia as well, but the world as a whole, to move away from the dollar's monopoly in the oil markets and the pricing of oil globally, as had been the case really since 1971, for a very pragmatic reason, which is the geology of oil is such that we are in a period that I call peak cheap oil. It's not to say we're running out of oil. It's to say that the incremental oil barrel we are discovering, bringing online, commercializing, and producing keeps getting more expensive on average. Shale, great renaissance, a lot more supply, significantly more expensive than even some of the deep water, and let alone the sort of traditional, Saudi, Russian, traditional conventional fields. Um, that in turn reverberates back into the debt and sovereign debt markets because, again, if you remember before, Treasury bonds have been the primary global reserve asset for a long time. So basically, one way of looking at that is to say foreigners buy Treasury bonds to hold them as their piggy bank of savings for a rainy day when they need to convert them into dollars to buy something, to import something. As a practical matter, for oil importing creditors of the United States, so China, Japan, Korea, to a lesser extent, Europe, as a practical matter, that means they need treasuries at times to convert to dollars to import oil and gas. That means they need those treasuries to hold their value in oil and gas terms over time. Because if they trade with the US, they get dollars, they convert those dollars into treasuries, and then those treasuries decline in value against oil over time. They end up with a situation where they don't have enough dollars to import the oil they need to grow their economy. They run out of dollar reserves. Once they run out of dollar reserves, you end up with what we saw in Southeast Asia in the late 1990s with a currency crisis. So they need a currency, they need a savings vehicle that holds its value in oil terms, given the fact that oil is rising, the marginal barrel oil cost is rising over time. So we can see it's a matter of national security for China to switch to a currency, to switch to a savings vehicle to hold its value, and that savings value has been gold. If you look over the long term, gold holds its value, actually rises slightly versus oil over the long term. Um, and that's what's been happening. And so peak cheap oil in a significant way has contributed to the shift of central bank reserves away from treasury bonds toward gold. And so it's been a reinforcing factor to the dynamic I talked about before. It's a really important dynamic because the oil market every year is annual physical production terms about 12 to 15 times the size of the gold market in annual production physical dollar terms. So the oil market is much bigger than the gold market. It doesn't take a lot of the oil market shifting into the gold market to start squeezing the gold market higher and creating a virtuous cycle in the price of gold. At the same time, you're getting a vicious cycle in terms of treasuries with what central banks are doing in terms of shifting their reserves.
You have a graph on that on the spread between the value of oil and the value of the gold. It is huge difference in those two. So, like you
Yeah.
said, it would take but a little bit to move it in that area. So, let me ask you this: two things to sort of wind up on. A couple of things. Well, one of the things, you have a great chart about the variant perceptions in markets in 24 and what Wall Street cannot see. And you might talk about that a little bit.
That to me, I think, is really the big variant perception for this year and beyond, which is Wall Street is really, much of Wall Street at least, seems to be operating under the assumption that is held for all of our careers, which has been, certainly since the early mid 80s, the Fed is has a dual mandate: full employment and low inflation. And my view is that the market is slowly coming around to a view of the Fed's third mandate, which was a phrase we coined back in, I think, April of 2020, maybe May of 2020. Fed Chair Powell used the phrase, I think, two or three different times in one press conference, that the Fed had to act in the size they acted because the Treasury market was dysfunctioning. And so we said at that moment that Powell just introduced a third mandate of the Fed. That it had always been there in the shadows, but the debt level, the dynamic of foreign central banks not being incremental buyers, the deficit levels, etc., the level of the dollar, were all combining to thrust this shadow mandate that had always been there, which was proper functioning of the Treasury market and put it into being not just in the spotlight, but the number one mandate. And so I still think it is a minority view that the Fed's number one mandate is Treasury market functioning. In my view, the reality has always been that's the reason for the Fed to be there, is to make sure the Treasury is funded. It's just most of the time that doesn't matter because it's not, the debt deficit, et cetera. It's not a problem to get that done. I think increasingly with us being in this, fiscal dominance at times, that is now the number one mandate. And that has incredible implications for markets. If the Fed's job, if it's more important that the Treasury market functions than it is that the Fed gets to their inflation target, that has very important implications for allocations of various instruments. You can't, in my opinion, own long-term bonds as an investment in that world because it basically means every time Treasury market dysfunctions and they have to choose save the bond market or save the currency, they're going to save the bond market, which means the value of the currency relative to goods, services, gold, Bitcoin, oil will be sacrificed. So and importantly, we've had this thesis tested now 5 times since 2019. And every time the Fed has a choice, Treasury market or the dollar, they always choose to save the Treasury market. They inject the dollar liquidity, however much is needed to restabilize the Treasury market, and then they get going again and stocks go higher. And you can see this in the charts. If you run S&P 500 over TLT, which is just the long bond ETF, gold over TLT, Bitcoin over TLT, all these different instruments over TLT, what you can see is this spike around sometime between 2014, 2018, 2020, or 2022, depending on the asset in question, where Mr. Market is now saying, oh, I get it. The shadow third mandate is now mandate number one. Inflation is number three and employment's number two. I need to own assets. I need to shift out of long-term bonds into assets that will better preserve my purchasing power in a secularly inflationary environment. That is what is really the implication of the shadow third mandate being the number one mandate.
I think in one of your conclusions you drew from that was if the U.S. was going to go ahead and pay entitlements and the interest expense that they're paying at this level, that means that you're going to have much more negative rates in this particular. Did I understand that correctly?
Yeah, essentially. So one of the things we watch is just a timing mechanism for when the Treasury market is likely to get dysfunctional has been adding what we call the line item true interest expense. And it's simple. It's just gross interest of the United States. And we add in Medicare, Medicaid, Social Security as delineated in the quarterly Treasury Borrowing Advisory Committee report. And we add those numbers up, so that's just entitlements and gross interest, and we divide it by total federal receipts. And once that number gets to about 95% and is still moving higher, you're on the countdown to Treasury market dysfunction that the Fed and or Treasury will respond to with more dollar liquidity. Once that number gets to 100%, that tells you the United States is spending 100% of its receipts on interest and interest-like obligations, which historically has been when emerging markets, start to go into very inflationary periods. They have to decide, default on the debt or print the interest. And in this case, it's a broad definition of interest because I like using the entitlement side because that's really just, in my view, the current interest portion of a large off-balance sheet liability. But that's the decision. And it's default on the obligation or print the interest. And they always print the interest. And that's why we start, dollar weakness, stocks up, inflation, a few months down the road, back up, oil up, gold up, etc.
And don't you think that makes you vote for, as a portfolio move and we've said this all along now for the last year and a half or 2 years, you're going to have to keep those maturities of Treasury short, like real short.
Absolutely.
And I think it's interesting to note how much money keeps going back into long bonds over the last 3 or 4 months, because just like you said, Wall Street either hasn't figured it out or they don't care, one way or the other. But the last thing I'll say, and it's the last piece on your biggest variant You talk about, look, this is bullish for gold, it's bullish for Bitcoin, industrials, and I think I'm assuming anything is sort of tied to a real asset. Am I in understanding that correctly?
I think that's fair. I mean, I think within real estate, if you lump that into hard assets, I think we're in a bit of a unique period of time there in terms of what's happening with office and some of the transition in terms of online retail versus, traditional light strip retail. So, of course, I think I think real estate is a little bit of a different hard asset animal than it may have been in the past. It's much more case by case basis, but broadly speaking, absolutely. Hard assets, I think they have outperformed the long bond, and I think they'll continue to outperform the long bond um, given the situation we're in. It is what it is. The debt doesn't matter until it matters, and it matters now. The long term has arrived.
And I know we work with you on an institutional basis, but if you were talking to just a few individual investors on how they might take a look at this over the next 5 years, what would you suggest to them to keep in mind?
I would to suggest to them, number one, do not use leverage. This is likely to be a very volatile period of time. We've already seen that to a certain extent, but I think it will get more volatile, both by virtue of the amount of leverage in the system and the political and geopolitical implications, or they're very politically and geopolitically sensitive, all of this, and that's going to it's going to increase the volatility. So for me, if I was saying just the average individual investor, I think you want to be unlevered. I think you want to be diversified from the standpoint of, I think it's a great bellwether. One of the richest men in history as a percentage of the economy at that time was a man named Jacob Fugger, Fugger. You can Google and read about him. But he had this very basic allocation that he used for himself and his children, his heirs, of 25% cash, 25% gold, 25% real estate, 25% stocks, and rebalance depending on what happens. And I think that is, in a lot of ways, very wise. And for him, real estate, is probably, not just commercial development, but probably things like timber or things like
Yeah,
oil wells if
right.
they existed at the time, right? So I think it's for what we're going into, which is it has happened before in history, but it's been a very long time, and I don't know that it's ever happened at this scale in terms of the derivatives we have that didn't exist, and the social entitlements that we had that didn't exist in Western democracies 80 years ago. It has the potential to be much bigger and much more volatile than these types of situations have ever been before. And that's why I say be unlevered so you can't get carried out, and then, be diversified and be liquid, right? That's the 25% cash. You're plenty liquid there. You're hedging currency debasement. You've got real assets. You've got ownership stakes in productive enterprise. And I think, stay at the short end. If you're owning bonds, stay at the short end. To me, there makes no sense buying a 10-year at 4.6 when you can get 5 and change at the front end.
So true. Well, listen, it might be well to look at those four quadrants of that layout, but Mr. Fugger, and see what would happen. Because from a generational wealth standpoint, over 2 or 3 generations, probably not a bad idea. But listen, I want to thank you. And various times during this, we have put up your website and where people can go get your service. You do some great writing, and you also have some great videos that you come out with questions that I really enjoy as well. But I want to thank you very much for being with us, Luke. And if we can ever help you in any way, certainly let us know.
Will do. Thank you so much for your time, Ted. I appreciate coming on and having a conversation.
Well, hopefully we can see you again next year, see how things unfold.
Absolutely. Absolutely.
All right. Thanks a lot.
All right. Thank you.
Hello, everyone. I just want to say, if you like this video and you want to see more of this type of information, because we really try to get the information that you don't see from anybody else, then be sure and click on subscribe, and you'll see more of what we do here at Oxbow.